Now, manufacturing data in both the Eurozone and China showing some signs of recovery. In May, new orders declined at their slowest pace in 2 years over in Europe. That's improvement. While China's factory activity grew at the fastest since June of 2022. Meanwhile, S&P Global Manufacturing PMI here at home, it was revised higher for May. Confidence improving, hiring ramping to its fastest pace since last July. But yields across the board are lower today. The 10-year hovering around 4.4%. Stocks are also under pressure. Let's talk more about these developments now with Katerina Simonetti. She's Senior VP and Private Wealth Advisor at Morgan Stanley Private Wealth Management. Katerina, it's great to have you here today. Welcome.
Thank you for having me.
It's interesting how just in the span of about a week, what's changed? How do we go from having a stagflation or inflationary scare to now more of a slowdown one?
Well, Kelly, stocks are trading in the narrow range right now. We had a pullback in April, the snap rally in May, and now it seems to be that the possibility of the soft landing is back on the table. So there is enthusiasm about that, but now that we are early in the month of June, it's only natural that the market is going to be trading sideways a bit as we're figuring out the valuations. And it probably will remain in this range as we're going next into the next earnings season, when we will finally see some more headline-driven movers for the certain parts of the equity market.
I mentioned there's a lot of different manufacturing data out. Probably the biggie is the U.S. ISM manufacturing report. And it was a disappointment. It declined. I mean, this index has been in the gutter for a couple of years now. So the bulls are pointing to it, saying, ignore it. It doesn't matter. It's just manufacturing post-COVID specific. And the bears might say, well, at some point, this is information that the rest of the market and the economy might catch down to. Which camp are you in?
I think that the global economic rebound and the uptick in the manufacturing data, as well as recovering commodity prices, is certainly a positive indicator for the market. And we can use some of this positivity with the major concerns over the fact that we are in the higher interest rate environment, which of course is affecting the consumer. And as we see the rising credit card debts, which gives us a pause, and that's why we favor consumer staples over discretionary, for example, and we look at the portfolios for quality, because the data on our side indicate that Fed is probably going to stay the course, regardless of, the Fed meeting that's going to that is about to happen. They're most likely going to wait for the CPI numbers getting closer to their target data before they're going to move in the rates, which means that this environment is going to affect both consumer behavior and corporate earnings. So we'll take all the data for the global expansion and also manufacturing as a positive. We can use all the positive data we can get.
So let's talk about corporate bonds for a moment, because, again, if you want to kind of put together a constellation of data points, the fact that high yield and investment grade and all of these areas have been so strong would certainly belie the fact that we might have a slowing economy, or maybe suggest that manufacturing is in its own world. Do you like yields here where they are at almost generational tight spreads? Do you think that's factoring in enough for investors if we face a slowdown or a pickup in inflation? And again, just to use Michael Hartnett's phrase, this has been an anything but bonds bull market. So investment grade, high yield, where would you be? I mean, where do you think is attractive right now?
Kelly, we're overweight investment grade corporate credit, but with that, both treasuries and corporates seem somewhat rich at the moment. And this is if you take the short range view, but in the long-term view, as we should be taking when it comes to portfolio design, we are in the high interest rate environment, and we have not been in this environment for many years. So we tell investors that this is the time to improve the overall the quality of the fixed income portfolios, whether it's on the treasury side, investment grade corporates that we really like, and also the high yield and preferreds. This is the time to really take a very close look at the fixed income portfolios and make sure that they're positioned well going forward, so we can enjoy this higher rates, once we are in the lower interest rate environment. We don't know when it's coming, but it's on the horizon. So this is the time to take action.
Absolutely. If you think we're ultimately heading into a lower rate environment, it would seem like a no-brainer. Obviously, there are some out there, at least until this week, who thought that we might still see yet higher yields. Okay, so quickly before we go, what about energy? I mean, you mentioned here some plays like golds and REITs and commodities. We've talked a lot about real assets and so forth in this environment. But if you ultimately think a slowdown might be coming, what do you do with those areas and with energy?
We like energy companies. We think they're positioned really well considering limited supply and strong demand. They have been profitable and they are going to, in our view, continue to be profitable. So we very much recommend that they should be part of the portfolio. And also, energy companies pay really great dividends. And when it comes to so much uncertainty and the ups and downs of this market, which make investors so nervous, having this strong dividend plays on the portfolio is extremely important. And energy plays an essential role in that.
All right. We will leave it there. Katerina Simonetti, finding stuff to like pretty much everywhere. We appreciate your time today. Thank you so much. Joining me from Morgan Stanley Private Wealth Management.